Welcome back to the channel. I'm Algabot, and today we're taking a careful, educational look at an expert advisor for MetaTrader 5 called Momentum Divergence Reversal. This is a pure price action system that looks for the moment when a trend quietly loses steam. It measures momentum as a simple rate of change, and then compares that momentum across two swing points to spot what traders call divergence. Over the next few minutes, we'll break down how it defines a swing, how it detects that fading momentum, and exactly how it handles its entries, its stops, and its targets. Everything here is for learning only, so let's get started. Let's start with the big picture. Momentum divergence reversal is a reversal strategy, which means it isn't trying to ride a trend forever. Instead, it studies a trend for signs that the energy behind it is fading, and it positions for a turn. It's built entirely from price action. There are no oscillators drawn on the chart, no moving averages, and no other indicators. The only thing it measures is momentum, and it measures momentum in the most honest, transparent way possible. Momentum here is simply the closing price at a swing point minus the closing price a fixed number of bars earlier. That difference is the raw rate of change. When that number is large and positive, price has been climbing quickly. When it's large and negative, price has been falling quickly. When it drifts back toward zero, the move is slowing down. The core idea is comparison. A healthy uptrend should keep making higher highs, and each new high should be backed by strong upward momentum. If price grinds out a fresh new high, but the momentum behind that high is weaker than it was at the previous high, something has changed under the surface. Buyers are getting tired. That mismatch, a new price extreme that momentum refuses to confirm, is what this strategy calls divergence, and it's the heart of every trade. Because the logic is built purely from candle shapes and closing prices, it doesn't care what symbol or time frame you attach it to. It measures swings and momentum the same way, whether you're on a 5-minute chart or a daily chart. In terms of who it might interest, this is a strategy for traders who like patient, structure-based setups rather than constant activity. It only acts when a specific pattern lines up, so it can sit quietly for long stretches. As always, please remember this is educational information only. It is not financial advice, and trading always carries the risk of loss. Now let's walk through exactly how the strategy operates, step by step. Everything happens once per completed bar, so the EA is patient and works only with closed candles. The first job is finding swings. The strategy uses a fractal definition controlled by the SwingLookback parameter, which defaults to 3. A candidate bar becomes a confirmed swing high only if its high is above the highs of the 3 bars before it and the 3 bars after it. A swing low works the same way in reverse. Because it needs equal neighbors on both sides, the strategy waits a few bars before declaring a pivot, which keeps it from reacting to noise. Once a pivot is confirmed, the strategy measures momentum at that pivot. Momentum is the pivot's closing price minus the closing price a set number of bars earlier, and that lookback is the MomPeriod parameter, which defaults to 14. It then stores that pivot's price and its momentum so it can compare against the next pivot of the same type. Here's where divergence comes in. For a short setup, the strategy needs a new swing high that is higher in price than the previous swing high, but whose momentum is lower than the momentum at that previous high. Price made a higher high, momentum made a lower high. That's bearish divergence, and it arms a short. For a long setup, it needs a new swing low that is lower in price than the previous swing low, but whose momentum is higher than before. Price made a lower low, momentum made a higher low. That's bullish divergence, and it arms a long. Arming does not mean entering. The strategy then waits for confirmation. On each new bar, it checks for a decisive candle, one whose body is at least 40% of its total range, so it isn't a weak, indecisive bar. For a short, that candle must also close below its open and below the prior bar's close, showing real downside follow-through. For a long, it must close above its open and above the prior close. If that confirmation doesn't appear within the setup expiry bar's window, which defaults to 5 bars, or if price breaks past the pivot and proves the idea wrong, the setup is discarded. When confirmation arrives, the order goes in. The stop loss is placed just beyond the divergent pivot, offset by a fraction of that pivot bar's range set by the stop buffer fraction parameter. That's the point where the reversal idea would be proven wrong. The take profit is then set at a fixed reward-to-risk multiple of that stop distance, controlled by the reward-risk parameter, which defaults to 2 to 1. Only one position runs at a time. Let's read through the important pieces of the MQL5 code on your screen. At the top are the inputs. SwingLookback sets how many bars sit on each side of a pivot. MomPeriod is the momentum lookback of 14 bars, and setup expiry bars keeps an armed setup alive for 5 bars. RewardRisk is the 2 to 1 target multiple. Stop buffer fraction adds a small cushion beyond the pivot, and lots is the trade volume. Next are the 2 arming conditions, and this is where divergence is detected. The short block arms only when the current swing high is above the previous high in price, while its momentum is below the previous high's momentum. The long block is the mirror image. The current swing low is below the previous low in price, while its momentum is above the previous low's momentum. When either lines up, the EA marks itself as armed and records the pivot level and range. Below that are the 2 confirmation conditions. For the sell, the code checks that the just closed candle is decisive, closes below its open, and closes below the prior bar's close. Then it calls enter short. For the buy, the same candle must be decisive, close above its open, and close above the prior close. Then it calls enter long. Finally, look at the 2 order functions. In enter short, the stop sits above the divergent high by the buffer fraction. The risk is that stop distance from the bid, and the take profit is the risk multiplied by reward risk, placed below. Then trade. Sell submits the order. Enter long does the exact opposite. The stop sits below the divergent low. Risk is measured from the ask. The take profit is the reward multiple above, and trade by submits it. Same logic, both directions. Let's walk through this illustration candle by candle. The upper panel shows the price candles, and the gold line in the lower panel is momentum, the closing price minus the close 14 bars earlier. When that gold line is above the dashed 0 line, momentum is positive. When it's below, momentum is negative. The whole strategy lives in the relationship between these 2 panels. Start on the left. Price is sliding lower, and the momentum line dives deep below 0, reaching its lowest trough as the first swing low forms. That deep negative reading tells us sellers were firmly in control. Price then bounces, pulls back, and pushes down again to carve out a fresh lower low, a new bottom below the first one. Now watch the momentum panel closely, because this is the key moment. Even though price made a lower low, the gold line did not make a lower trough. Its second dip is noticeably shallower, sitting higher than the first. Price went lower, but momentum went higher. That is bullish divergence, and it suggests the selling pressure is quietly draining away. At this point, the strategy arms along, but it does not act yet. It waits for proof. On the very next candle, we get a decisive bullish bar that closes strongly above its open and above the previous close, showing real upside follow-through. That's the confirmation, and the buy entry marker appears. Notice where the protective stop sits, just below that divergent low, at the exact level where a deeper drop would prove the reversal idea wrong. The take profit target is placed above at twice the risk distance, reflecting the default reward to risk of 2 to 1. From there, price climbs candle after candle, each close a little higher, and eventually reaches the take profit target. The long trade is complete. Now the chart flips the pattern to show the short side. Price keeps rising into a strong swing high, and the momentum line surges to its highest peak above 0, confirming that buyers had plenty of energy at that point. Price then eases back, gathers itself, and pushes up once more to print a higher high, a fresh peak above the previous one. Look at momentum again. This time the gold line makes a lower peak. Price reached a higher high, but momentum could not match its earlier strength. That is bearish divergence, the mirror image of what we saw at the bottom, and it hints that buyers are becoming exhausted. The strategy arms a short and waits for confirmation. The next decisive candle closes firmly below its open and below the prior close, giving us clear downside follow-through, and the sell entry marker appears. This time the stop sits just above the divergent high, again at the level that would disprove the setup, and the take profit target is placed below at twice that risk. Price then rolls over and slides down, candle by candle, until it reaches the take profit target and the short trade is complete. Notice that both trades used exactly the same principle. In each case, price stretched to a fresh extreme, a new low or a new high, but momentum refused to confirm it. That single mismatch, a new price extreme unsupported by momentum, is the entire thesis, and the decisive confirmation candle is simply the strategy's way of waiting for price to agree before committing. Of course, not every divergence leads to a clean reversal, which is why the fixed stop and the expiry window exist, and why trading always carries the risk of loss. So let's quickly recap what we covered today. Momentum Divergence Reversal is a pure price action expert advisor that measures momentum as a simple rate of change and compares it across consecutive swing points. When price makes a new extreme that momentum refuses to confirm, it arms a reversal, waits for a decisive confirmation candle, and then places a stop beyond the pivot with a fixed reward-to-risk target. We looked at the logic, the code, and a full chart example of both a long and a short. Remember, this video is educational content only, and it is not financial advice or a recommendation to trade. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like to see next. You can learn more over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.